Hello, this is Bob Woosley with Frazier Deeter, and we're here with Sean Lager, audit partner with Frazier Deeter. And today's topic in our podcast is lease accounting, which is a pretty hot topic in today's marketplace. Sean, tell us a little bit about yourself before we start talking about lease accounting.
Thanks, Bob. As you said, I'm an audit partner at Frazier Deeter. Also served on the AICPA's Technical Issues Committee as vice chairman when the lease accounting standard was being deliberated. I also serve as the chairman of PCAF International's Professional Standards Group, whereby we monitor professional standards with our firms in over 150 countries around the world. I focus in several different industries, but one of my jobs here at the firm is to monitor and consult on the new RevRec standard, ASC 606, as well as the new lease accounting standard.
Right. So you and I have been talking about this lease accounting standard for a couple of years now.
Or longer.
Or longer. So if our listeners have a problem with it, they can blame you for being part of the group that helped set the standard. Just kidding. So Sean, tell me a little bit. I mean, the way I understand it is in the old operating lease, capital lease, vernacular. I mean, is the net of this thing just getting all operating leases on the balance sheet?
I think that's fair to state, Bob. As Sir David Tweedy put it, who was the former chair of the International Accounting Standards Board, his goal before he retired was to ensure that the airplanes he flew on were treated as or accounted for on the balance sheet. As you may know, a lot of airlines lease their airplanes and are treated as operating leases, from what I understand.
Yeah.
So in effect, the standard does bring most operating leases that are at least deemed not short-term leases with terms 12 months or less onto the balance sheet.
To be a more fair representation of debt and equity, and is that what the AICPA was after, is to get a better representation or better matching?
Well, yeah, the Financial Accounting Standards Board was to put those obligations on the balance sheet. It's simple as this: if in their view, which I tend to agree, if you sign a non-cancelable lease over a long period of time, that's an obligation.
Right.
So the example I give a lot is, let's say you own a manufacturing company and you have two pieces of equipment. One you lease, let's say over a 5-year period, and one you acquired, okay, and through term debt,
right,
say, for example.
And that's clearly an asset and liability in that case.
Clearly an asset and liability when you have term debt and have the asset. Well, how is the obligation different when you lease it? You've got the right to use an asset, you have control over it, you're getting the economic benefits of that asset. And of course, under current accounting, that's not reflected on the balance sheet if it's an operating lease. So you look at the liability, you've got an obligation to make lease payments over a 5-year period of time.
Right.
So that's something that I've always struggled with over the years under FAS 13, where we had bright lines to determine if something was an obligation or not.
Right.
I never really understand.
People
conceptually,
and they would engineer those leases under FAS 13 to become operating leases.
That's exactly right.
To keep it off the balance sheet.
That's exactly right. And when I see errors in lease accounting, making those judgments, I see errors in using an inappropriate rate to determine whether or not you pass or fail the 90% test.
Right.
So yeah, and that can change the results of whether something is an obligation on the balance sheet or whether it's not.
So FASB said, what the heck with all this, we're going to get these obligations on the balance sheet. So what used to be engineered operating leases are now what I used to call capital leases, which are going to be on the balance sheet. So when is this thing enacted? Is there any difference between public or private companies? I mean, when do companies have to think about this? Probably already, right? But But what's the date on these things?
Yeah. So yes, there's a difference between public and non-public. Of course, public companies are a year earlier, as it was under ASC 606, the RevRec standard. So they're effective public companies for years beginning after December 15th of this year. So next year, calendar year public companies have to be compliant with the new standard. For private companies, there's a year after that.
So 12, 15, 19? would be the year after.
Yeah, for fiscal years
Beginning after that. So
right for the interim period.
So the public companies are they're implementing this now.
Yeah,
right.
Yeah,
For their quarterly for their queues.
Next year they'll have to be compliant in their queues.
Okay, so talk to me a little bit about so companies have had tons of leases, they're operating leases. Now they have to comply with this new standard. What do they do? What are their steps? What are you advising your clients? How do they go forward with this thing?
That's a good question. The first thing is understand the leases that you have, and what I mean by that is if you're preparing financial statements already, say they're audited.
Yeah.
The public is easier because you already have process controls. You're reporting quarterly, et cetera.
Right.
Non-publics can be not as simple as. So it just depends on whether or not you're preparing financial statements. But what the starting point is get a schedule of your leases.
Mm-hmm.
Okay, and the key is getting a complete schedule of your leases, and that's going to be determined on how many leases you have, and of course it can get more complex. And the reason I say that is in the non-public world is the concern because there's less focus on it. It's a disclosure, right? As it is for publics, but you're not held to a high standard for internal controls, and disclosures at times can get glazed over.
So there's an operational issue that people may just not have a handle on their leases, right?
So they not have a good handle, especially when you have a lot of, say, car leases or non-real estate type leases. That the more leases you have, the more complicated that could be. So the first step is to inventory your lease arrangements.
Okay.
Obviously, ensure you've got a complete and accurate listing of leases and the terms, et cetera. What we've been advising clients to do is go through the process to where you're preparing pro forma financial statements with the effective numbers. So the second step in that is, after you're inventorying, is start your lease assessment process. And I think the key is when I say inventorying leases and the lease assessment process is not only the operating leases, but do you have embedded lease arrangements where those may have been glossed over because the accounting implications may be the same when you have a service arrangement and embedded asset within that service arrangement.
Yeah.
Where, gosh, well, I account for this service contract. The outcome will be the same under current guidance if I pull the lease out and determine it to be an operating lease and then start accounting for it or not material. The difference now is that lease will now go on the balance sheet.
Right. So that embedded lease is going to be treated differently.
That's exactly right. Yeah. So you're going to, when you're the lessee, you obviously going to have all your operating lease arrangements in your disclosures, and you turn the operating leases. Then you're going to look at your contracts and determine what contracts have embedded leases that, again, your eyes may have glazed over.
Probably never focused on it.
May have never focused on it. You're going to pull all those out. So that's going to be really important. And then you're going to have to start, determining, are these still lease arrangements under the new standard? Now, the new standard provides for an assessment of determining whether an arrangement contains a lease, and it's very, very similar to today.
Yeah.
The issue I see is I call it more clarifying guidance in the new standards. So where you may have not applied current guidance correctly or accurately, and
they tighten that up,
tighten the screws on it, and give them more clarifying guidance and some small nuance differences. So so the second step is inventorying all that and determining operating versus capital. Now, you're still making that determination, by the way.
Right.
Okay. And I'll speak more to that in a minute. But and they should be similar today. If you have an operating lease today, in general, it should be an operating lease tomorrow.
Okay.
Differences going on the balance sheet. So you want to take a step back and look at that. Then the next thing, which becomes problematic, is going through your lease arrangements and carving out the non-lease components, because the non-lease components aren't considered to be lease payments.
Right.
All right.
Yeah.
You have to determine what the lease payment is, determine what your liability is.
So it's just a ton of analysis that has to be done.
Right. A ton of analysis, exactly.
Are your clients deferring this? I've seen some people kick the can down the road. I guess people always feel they have a little bit of time.
In the non-public world, yes, the can does get kicked down the road because you don't have the regulator breathing over you.
Because they're reporting their results to the bank and their
Right.
shareholders, so they have covenants maybe in their debt agreements.
Right.
That seems like that's going to be a nightmare. I mean, if you got debt equity ratios with, say, Bank of America, and you've got your credit out there with them, it's the same company, but their debt service coverage ratio, their debt equity ratio are all going to be different. How's that calibration happening? I mean,
that's a good question, and in fact, it's one of the main reasons where the can shouldn't get kicked down.
Should not get kicked down.
Right, exactly. Yeah. And what I mentioned earlier was we were trying to get clients and friends to pro forma this out and have a conversation with their banker.
Sure.
And it's being proactive versus reactive. Right.
Yeah.
Hey, by the way, I've got, for example, debt to equity ratio. Now I've got these liabilities coming on the balance sheet.
Right.
Sit down from the banker. First, understand your obviously terms of your arrangement. Your debt arrangement. Do you have a clause or a gap measurement change? Is your covenants
in your debt agreement that allows them to adjust? It doesn't penalize the borrower.
That's exactly right.
Have you seen some that don't do that? I mean, really?
Yeah,
wow.
Yeah. So the key is to be proactive and pro forma this out. Have a conversation with your banker and ensure that you're on the same page of the potential impact, because when this becomes effective, you're throwing all these leases on the balance sheet and the obligation, the asset pop up.
Right.
Okay.
Yeah.
And, if I'm a CFO or controller or chief accounting officer, I want to know the answer versus kicking the can down the road and having discussion later. I want to know now.
Yeah.
It could impact covenants. Now, it's important to note that bankers, when they look at your creditworthiness, they are taking your operating lease payments. They're calculating an obligation already.
Right.
And they take your lease arrangements and apply a factor, maybe 6, 5, or 7.
Right.
It's an industry standard. I still understand where the numbers come from.
Yeah.
And so they put it on your balance sheet for you. Difference is you're going to come up with a different number just by virtue of how to calculate these things.
Well, theoretically, it's going to be easier for the bankers once this is implemented, because they don't have to go through those machinations of trying to figure out how much debt's really encompassed with the operating leases. And
ironically enough, when when I was on the technical issues committee, there were thoughts that, well, first the PCC, Private Company Council, and TIC were trying to get relief for non-publics.
Okay.
In this standard, saying, hey, everything's fine. We're giving bankers the information they want. But the board pushed back because they said, hey, by the way, they're putting these on the balance sheet already.
Right.
They're obligations.
Yeah.
Okay. We're giving bankers better information.
Right.
So it's hard to argue that fact.
Yeah.
Okay. That you're giving bankers better information now.
Yeah.
Than they have.
Yeah, they'll probably go away.
Giving better information than they have now.
They could actually just take the financials, once it's been, the new standards have been applied.
Exactly.
What about like EBITDA and valuation? Like, I work with a lot of private equity firms. I mean, I have to run through all the machinations. You're going to amortize the asset, but isn't EBITDA going to change? I mean, under the new standard?
Yeah. So well, yes and no.
Yes and no, because you get amortize the asset.
Well, yeah. So the operating lease model, and a lot of pushback that was given during the whole proposal process was the impact to the P&L, because under previous exposure drafts prior to the final standard was that the model they were coming up with, the board, was a model that front loaded the impact to the balance sheet, i.e. in the way of amortization, interest expense.
Yeah.
When you're unwinding the obligation and amortizing the asset. So that was the pushback. So they came up with a new model where it gets your asset and a liability on the balance sheet, which is what the board wanted, but accommodated the P&L where if you have an operating lease, you still have straight line lease accounting. Here's the kicker.
Okay.
One could argue that, are we still going to, I choose my words carefully, work to intend to result, meaning that, okay, if I'm a private equity firm, right?
Yeah.
And I've got an operating lease, do I have drive to make that a capital lease, okay, or vice versa, I should say.
Mm-hmm.
Okay, I got a capital lease, I want it to be an operating lease, or operating lease be capital lease, because the impact EBITDA, right?
Yeah,
Because well, think
yeah,
about it.
yeah.
Because if you've got a capital lease, okay, you're taking the amortization and the interest out, right? To
Right.
get your EBITDA number.
Right.
If you've got an operating lease, it's still diluting down your EBITDA numbers, rent expense.
So we'll have an impact. I mean, that's but what you're saying, it maybe not as much because the FASB kind of anticipated that. And am I hearing you? Are they amortizing the asset faster? I mean,
that's okay. So I probably should have started here. So if you have if you had a capital lease today,
right?
Okay. Then and it's a capital lease tomorrow. Your P&L looks the same. You got amortization.
Yeah.
You got an interest expense.
Yeah. It's the operating lease.
Right. It's the operating lease. If you have an operating lease now, okay, you have an operating lease then, it's still rent expense.
Mm-hmm.
Okay.
Mm-hmm.
So that's where you get the disconnect between the balance sheet and the P&L, because you got to unwind the asset and liability for an operating lease.
Right.
But the cost, that straight line, is rent expense. It's not depreciation, amortization.
That's interesting because you're right, because that doesn't affect EBITDA at all.
Right. Real estate groups had a fit with the old model because they wanted straight line accounting and couldn't.
That makes sense.
You see?
Yeah. Well, that's interesting. I hadn't thought about that. I can tell you right now from our private equity firms, they're really standing by waiting to see what happens. They're not immersed in this yet, so I think I think there's a lot of opportunity to educate the users of non-public financial statements. Like the banks and the private equity firms. So this has been great, Sean. I mean, if you had to wrap up, if you were going to give a client advice on how we can help them with this change, I mean, what are they asking us to do? What can we do at Frazier Deeter to help them?
Well, first is to have a conversation and
educate them,
and understand the business,
which is part of what this podcast series is designed to do.
That's exactly right, and understand the potential significance of the impact. If you're an operating company and you lease your office space or you lease a building and you've got some smaller lease arrangements, whether it's assets around the office or a car or two or three, then obviously the impact's not going to be great, even though you'll see those leases creep on the balance sheet. Yeah. So a lot of work to be done, not really. Mm-hmm. Okay. And they may have good processes to capture these numbers, and at the end of the day, they're just probably figuring out first, once the asset and liability are determined, the operating asset and liability, then how do I account for this quarterly and understand the mechanics, because the mechanics are a bit odd.
The journal entry is going to be different.
Right, exactly. And we've got ideas on how to do that pretty easily.
Yeah. Okay.
Then you've got the company has multiple lease arrangements, multiple assets, where there's risk in the numbers in the sense that have we really already captured all of our lease arrangements? How extensive is our inventory going to be?
Like the embedded lease that you were talking about.
Right. Exactly. Right.
Easy miss.
Mm-hmm. Yeah. Easy miss. Exactly. Yeah. And so then it's, I look at it as a top-down approach and understanding where my leases are, where my leases could be that I've been accounting for.
Get your arms around it.
Get your arms around it and guide the company to the extent they have internal resources to start the inventory process.
Right.
Because you don't need to pay, high-priced advisors come and inventory your lease arrangements. Yeah. And we give them ideas on how to bucket things and group things.
So you just give them guidance on how to capture it and how to categorize it. Right. That's probably invaluable.
Right. It is. And to be quite honest, a lot of this can be achieved internally, and again, it depends on resource constraints and all that. Yeah. And then the next step is, how we're going to approach the carve out and lease and non-lease components. And one thing I didn't mention earlier was that there is a practical expedient, and will help the client think through whether they want to exercise or not. That allows a company to say, hey, you know what, my lease arrangement, I don't want to go through the process of carving this thing out. Mm-hmm. Okay. Yeah. Too many leases, too exhaustive for whatever reasons. And it is a buyer beware if you do that, because what happens is those non-lease components go in the lease component, and which obviously creates a higher payment and a larger liability. Okay.
Right.
So there is a price to pay for that. So we help them think through that.
Yeah.
And then get to the extent you've got, pro forma financial statements as of the beginning of the period of when you want to adopt.
Yeah, and maybe help coach them how to communicate with their third-party users like the bank and the private equity firms, and that's excellent.
And we've got relationships with lease software companies, in determining whether you need a software or not.
You mean a tool to do it?
A tool to, because you got day two accounting.
Yeah.
And so once the advisors step back, they have to count for these leases on a go-forward basis within their own process controls and systems. And as you may or may not know, a lot of these operating leases are on a massive Excel spreadsheet.
Right.
Now, the board contends, and I tend to disagree with this, that
the FASB board.
Board is that, we didn't want to make it more onerous. You can just take your big Excel, 5-year commitment schedule that you keep internally, drop a couple columns in, run numbers, and call it a day. And it's not that easy. Okay.
So there are software tools that you could recommend. Well, Sean, I think this is you've helped explain it to me a lot better. I think this is something that companies, it sounds like they just need to pay attention to it. I mean, it's got major impact. It's coming. I guess in an ideal scenario, they ought to start looking at it now. It's definitely the publics for sure, right? And then
without question.
But the non-publics.
The non-publics, the same. They've got banks.
They got users.
The banks, I look at it as one of your largest investors at times.
Yeah.
And so why not be proactive and have a conversation?
Or they're owned by a private equity firm, or they're,
exactly.
No doubt about it.
To understand the impact, right.
Well, this has been great. We may bring you back for an update on how things are going. I'd like to hear maybe a little bit later this year about how pain your clients are going through, what they uncovered when they're implementing this and doing their inventory of leases. It would be kind of interesting. Maybe we can bring one of our clients even to talk about that with us on one of these podcasts.
That's fine.
Well, that's great. So for anybody who wants more information, our website is www.frazierdeeter.com, and Sean, I think we'll put your contact information on this podcast, but I know it's Sean, SEAN.Lager, LAGER, at FrazierDeeter.com. And Sean, thank you a lot for coming today and explaining this.
Thank you, Bob.